All right, so good morning, good afternoon, or good evening, depending on where in the world you are catching me from. We've got over 5,000 people in the room today, I believe from over 80 countries. So thank you so much for joining me today. I know some of you stayed up really late or woke up really early in the morning, so I really appreciate that. And so for the next 2 days, we're starting it. We're going to do it tomorrow as well at the same time. The next 2 days, I'll be sharing with you, how do you beat the market? How do you kick the ass out of the stock market? How do you achieve consistent returns, double-digit returns investing in the stock market? And how do you build a multi-billion-dollar portfolio from an average income? And ultimately, how do you achieve financial freedom from the rat race? So make sure you've got a lot of writing materials, take lots of notes. And if you've got questions, post your questions on the chat, and I'll do my best to answer all the questions by the end of the webinar. But along the way, I believe that many of my sharings, my presentations will answer those questions indirectly. Okay, so if you're ready to go, let's start. All right, so, from South Africa, from the UK, from Australia, from the US, all coming in. Thank you very much, guys. And it's still streaming in. Okay. Now, every single year, we've got hundreds of thousands of people coming into the market with the hopes of beating the market, with the hopes of making a lot of money, okay? But the reality is it easy to beat the market? Here's a fact. Here's a sobering fact. And the fact is this: 80% of retail investors or traders lose money in the stock markets. Think about 80% of retail investors and traders lose money in the stock markets. And in fact, stockbrokers have reported that in terms of day trading, people who day trade the market, it's even worse. They found that 80% of day traders lose 80% of their money in 80 days. That's a sobering fact. Now, here's the funny thing. 80%, I keep repeating it again and again, so I need to get it in your head, right? 80% of retail investors lose money in the stock market, despite the fact that the stock market always goes up. Think about it. Isn't that insane? The stock market always goes up. The market has been going up ever since it started in 1792. Over the last 227 years, the market has only gone up. In fact, in the last 120 years, from 1900 to 2020, the stock market has gained 41,000% all the way up. So if you think about it, even a blind, one-legged monkey could make money in a market that always goes up. So why is it that 80% of retail investors lose money in a market that always goes up? They must be doing something wrong. It's not the market's fault. It's their fault. They are doing something wrong. So what are they doing wrong? Let's find out. What do you think the majority of investors do that causes them to lose money? Let's run through the list. And if it's one of you, right, type me, right? Sometimes we've got to be honest with ourselves. We have to know where we are before we can get to where we want to go, before we can change, right? There's a saying, for things to change, I must change first. Trouble with people is they always think, for things to change, the market must change. For things to change, the Fed must change. For things to change, my wife must change. No, for things to change, we must change. All right. So what do most investors do? Number one, the majority of investors, they tend to buy when they are feeling good, when they feel optimistic and confident, they buy. And they sell when they feel fear, when they get fearful, right? So in other words, they buy and sell based on emotions. That's right. Again, do you do that? If you do, type E, okay? Number two, most investors, they buy on good news. When they read some kind of good news, hey, got a vaccine, let's go buy some stocks. They sell on bad news. Hey, I heard that there's going to be a lot of retrenchments and people are going out of business. There's going to be another lockdown. Sell, right? In other words, they follow the crowd. They do what everyone does. Next, most investors, they make decisions by listening to expert opinions on the mainstream media. Like this guy called Jim. Just kidding. Jim's a nice guy. Anyway, right? But people, they go on CNBC. Sometimes it says, CNBC can never be correct, right? No, I'm just kidding. But, they read the mainstream news, they watch TV, they go on YouTube, they look at all these doomsday, porn disaster people, and they listen to all these opinions, right? Market's going to crash, gold's going to go up, and they buy and sell based on listening to other people's opinions, right? Next, they make decisions based on economic news, right? They look at unemployment, they look at GDP. Do you do that? If you do, type me. Okay, next. Most investors, they attempt to predict the short-term direction of the stock market. Most people, what they do? They look at charts. They say, okay, based on the charts, I think the market's going to go up this week, this month, or this day. All right, they use technical analysis to predict short-term price movements. If they can't predict it, what do? They listen to the predictions of other people, showing them different charts. One of the things that you got to understand is this, right? No one can predict the short-term direction of the stock market. No one. Not me, not Buffett, no one. Why? Think about it. Stock prices go up and down every day, every week, every month, right? Share prices are driven by demand and supply, which is driven by emotions of most people. People buy on greed, sell on fear, right? So to predict the short-term movements of the market means you have to predict the short-term emotions of millions of people in the world. I don't know about you, but I can't even predict my wife's emotions the next morning. So how can you predict the emotions of millions of people in the world? It's impossible, right? But that's what people tend to do. Next, most investors, they jump into the hottest stocks. Whatever's been going up, Tesla, let's jump in. Beyond Meat, let's jump in. Square, let's jump in. And they avoid stocks that have been underperforming. Okay? Now, I tend to do the opposite of that, and I'll talk more about it later on. Next, most investors, they invest in the markets without first investing in themselves. In other words, they jump into the markets without the proper knowledge, skills, and training. They know nothing about how to analyze businesses. They know nothing about how to look at technical patterns. They know nothing about money allocation, right? So it's kind of like there are a lot of people out there driving cars at high speed without getting a driving license, without going for driving lessons. What do you think is going to happen? It's a matter of time they're going to get into an accident and get hurt financially. And sadly, that's what most people do. They drive without driving lessons, right? And so that's what most people do. Okay, and that's why most people lose money. So if you think about it, if you want to make money, what must you do? You got to do the opposite of what everyone is doing. Okay, I don't know how many of you love this show in the 80s and 90s called Seinfeld. How many of you have watched Seinfeld? How many of you love Seinfeld? Okay, now Seinfeld was one of my favorite sitcoms. I still watch reruns today, right? And one of my favorite episodes of Seinfeld was about this guy called George Costanza, right? George Costanza, he's this loser, right? No job, no money, no girl, lives with his parents, right? And one day in the episode, he said that, why am I a loser, right? If all the decisions I made in the past was wrong, then the opposite would have to be right, okay? So in one episode, he did the opposite of what he did in the past, right? And when he did that, he became successful. And it's the same thing here, okay? So if you want to be the minority of people that beat the market every single year, that makes money in the markets, you have to do the opposite of what everyone is doing. So what does that mean? Well, that simply means that you have to buy when you are fearful, right? That's right. You buy when there's fear, when people are panicking. Oh my God, that's when you buy. That's when I buy, right? And when people are getting optimistic, all right, things are going great, that's when you stop buying, even take some profits. Okay? You want to buy on bad news. Whenever I read bad news, right, people are boycotting Facebook, I buy Facebook. Okay? There's a health scare, right? I buy McDonald's, right? You do the opposite, right? And you want to sell on good news, or you don't buy on good news, right? Next, you never want to listen to expert opinions on the mainstream media. I'm sure you watched my introduction, right? What do? Never watch the mainstream news. It will only screw you. And that's why I took that baseball bat and smashed that TV. Remember that? Okay, never read the economic news, right? GDP, unemployment, inflation. Reading the economic news is a total waste of time, because the stock market is not the economy. Remember that. The stock market is the leading indicator of the economy. More on that later on. Next, okay, never attempt to predict the short-term direction of the stock market, because no one knows where the heck the market's going. And making money from the market has nothing to do with making predictions about it. That is the biggest lie and the biggest myth ever perpetuated by the media, that you have to predict the market to make money from it. I'm sorry, wrong. I can't predict the market, but I make money every single year. Okay. Next, don't jump into stocks that look hot. And in fact, you want to look at stocks that are not hot yet. You want to get in before they are hot. And once they are hot, you don't want to get in anymore. Okay, it's the opposite, all right? Before ever buying a stock, before ever investing in an asset, please invest in yourself first. You are your greatest asset. And I can bet you, every $1 you invest in yourself, it will produce a lot more multiples than investing in anything else. I'm 46 years old. I've been in the markets for over 20 years. I've read almost every single book written on investing and trading. All right, from really old books to really new books. I've invested thousands of dollars attending seminars online and offline over the years. I've read hundreds and hundreds of books, and I'm still reading, I'm still learning. You got to invest in yourself. Okay, so let me summarize by saying this. The stock market is a device that transfers wealth from one person to another person. Very, very simple, right? And it's a device that transfers wealth from the ignorant people, those who know nothing, with no knowledge, no skills, to the competent, those who are trained, they have knowledge and they have skills, right? It transfers money from the emotional to the rational. If you want to make money in the markets, you must have no emotions. You must have zero emotional attachment to money. I've got no attachment to money. I've got no feelings when I make money. I've got no feelings when I lose money. I get excited when I teach. I love teaching. I get excited in terms of relationships. I love people, but money doesn't give me any emotions at all. I like to make money because to me it's like a game. It's like playing chess, and money to me is kind of like the points in the game, but I've got no emotional attachment to money whatsoever, and that's why I can make decisions that are completely rational. Okay, the stock market transfers wealth from the impatient to the patient, from the pessimist to the optimist. I'm sure if you go on YouTube, you'll find that 9 out of 10 videos are pessimistic about the world, right? The world's going to crash. It's a doomsday scenario, right? And all these people are losing money, and they get angry when people do well. So they post even more disaster, right? So the stock market transfers wealth from the majority, 80%, to the minority. So ask yourself, which one do you want to be? Okay. If you want to be the minority, you have to do the opposite of everyone else. So it's time you learn the real facts that will allow you to profit and beat the market consistently. Are you ready for the real facts? Are you ready to see the truth? To leave the matrix and to see the world as it really is? If you are, let's begin. Here are a few facts that you need to know to make money, right? Fact number one, the US stock index always goes up in the long run. Always has, always will, okay? Like I mentioned earlier, the US stock market has been around for 227 years. It started in 1792, right? Now, I don't have that 200-year chart, but over here you can see the 119-year performance of the US market from 1900 to 2019. You know, a lot of people are fearful of investing today. They're saying the world has so many problems. There's unemployment, there's depression, there's recession. You know, is it a good time to invest? Take a look at the last 100 years. Have we had problems in the past? Yeah. In 1916, we had World War I. In 1929, we had the Great Depression. In 1940s, we had World War II. In 1974, we had the oil crisis, and Adam Khoo was born, another crisis. 1987, we had Black Monday, the stock market crash. In the year 2000, we had the dot-com crash. 2008, US financial crisis, European debt crisis, trade war, COVID-19. Now, despite all those problems, guess what? The stock market keeps going up. And you will always go up in the future, 5 to 10 years from now, okay? So right now, the Dow Jones is at about 27,000 points. 27,000 points right now. Eventually, it will go to 50,000 points without a doubt. It will go to 100,000 points without a doubt. It will go to 200,000 points without a doubt. The question is when, I don't know, but it will get there. Does it make sense? So if you know that the stock market will always go up, why is there fear to invest? There's no more fear because you know that it's rigged to always go up. Question, why does the stock market always go up? What is the logical reason? Now, there are a few reasons. Reason number one is because of inflation. Excuse me, inflation, right? So let me ask you a question. In the future, in 5 to 10 years, would McDonald's sell the Big Mac at a higher price? Of course. Would Nike sell their shoes at a higher price? Of course, okay? So over time, companies will raise prices on their products. So as they increase their price, what happens? Their sales revenue increases in dollar terms. Their net profit increases in dollar terms. Now, share price is always driven by earnings per share. The higher the earnings per share, the higher the profits per share, the higher the share price will be. Does this make sense? So inflation guarantees higher prices. So people have been saying to me, Adam, now that they're printing money like there's no tomorrow. As they print money, what's going to happen? There's more money, more currency. It will lead to inflation eventually. Inflation is the rise of asset prices. The higher the inflation, the higher stock prices will go. So inflation makes the rich richer, but it makes the poor even poorer because the rich own assets, the rich own real estate, the rich own stocks. So inflation pushes up the prices, they get richer. But the poor get poorer because the poor don't own assets. The poor, they get a salary, they get wages, and their wages are worth less and less over time with inflation. So the only way to beat inflation is to own assets like quality stocks. Now, bear in mind that when I say that the stock market always goes up, I'm only referring to the US market, not necessarily other markets. Why? For example, look at Japan. Okay, Japan does not have inflation. Japan is deflationary. And that's why when you look at the Japanese stock market in the last 20 years, it has never gone up because there's no inflation in Japan. Does it make sense? Okay. The second reason is population growth. The question is, in the future, will there be more people in the world today? Yeah, more people are born than people die. So more people means more demand for goods and services, right? So in the future, McDonald's will sell more hamburgers than today because more people will be loving it, like their CEO. Just kidding, right? Nike will sell more shoes in the future because there are more people who will be just doing it, right? More running, more jogging, right? So more people, more consumption. So these companies have to keep growing bigger and bigger to supply a bigger population. So as they grow bigger, the value of their shares will increase and their share price will increase. Again, it doesn't apply to all countries. If you look at Japan, for example, Japan, they do not have population growth. Their population is declining and aging, and they don't have a lot of immigration. And that's why, again, Japanese stock market has been going down for the long run because they don't have growth in consumption. Okay. Number three, third reason why the stock market will always go up is because of index rebalancing. What does that mean? Now, understand that the stock market is measured by an index. Okay. And in the US, there are many indexes. One of the main ones is called the Dow Jones Index. So what's an index? An index is a basket of the biggest companies that have been selected to represent all the companies. They're kind of like the representatives, the members of parliament or the members of Congress. Okay. So for example, in the US market, there are about 4,000 listed companies. And out of the 4,000, they select the 30 companies to represent everyone. So among the 30 companies, you have got Microsoft, Cisco, Intel, Apple, Walt Disney, IBM, 3M, Johnson & Johnson, Coca-Cola, Procter & Gamble, and so on and so forth, right? So when we say that the stock market goes up, it does not mean every single stock goes up. It only means the index goes up. And the index is the average price of the 30 representatives. Does it make sense? Okay, now here's the thing. Is it always the same 30 companies? No, they change it all the time. So the moment a company is no longer a leader, very profitable, it get kicked out of the index and it gets replaced by a different company. So for example, you've heard of AIG Insurance, General Motors, General Electric, Citigroup, right? So these four companies, they were in the index many years ago, but they have been kicked out because they are no longer very profitable, and they were replaced by four better companies. They were replaced by Visa, Apple, Nike, and Goldman Sachs. So in other words, it is always the best 30 companies that represent the index. And that is why it is engineered to always go up. Does it make sense? Okay. The fourth reason the stock market will always go up is because of the Federal Reserve. Now, the Federal Reserve has the power to print unlimited money and to support the stock market. So what does it mean? It means that the stock market cannot go down. Because once the stock market goes down by a certain amount, the Federal Reserve will print money and buy up assets to push the market up again. So the Fed is like the Avengers. They do whatever it takes to save the world, right? So when people say, Adam, is the market rigged? I say, of course the market is rigged. It's rigged to always go up. It's the greatest wealth machine in history. And if you don't take advantage of it and buy stocks, you are insane. All right, does it make sense? All right, so fact number one, the market always goes up. Now, so people say, Adam, when is the best time to buy the index, the Dow Jones index, or to buy the S&P 500 index using ETF? When's the best time to buy? Now, if you think about it, you can buy anytime. Buy anytime because you always go up. Eventually, you always go up. But of course, the best time to buy is when the market is temporarily down because you get a good price. Remember, the lower you buy, the more gains you make when it goes higher eventually, right? So when does the market go down? When is it a good time to buy? In good times or bad? Bad times. In times of fear or optimism? Fear, that's right. So think about it. Every time there's a panic, there's fear, the market goes down. Oh my God, you buy. Oh my God, you buy. Oh my God, you buy. If you buy every time there's a panic, you get in at the best price. You make the greatest gains as it goes up. And you will see later on, that's how me and my students and I, we get 30-40% returns a year. Why? Because we buy at the point of maximum panic. When we buy when everyone is panicking, we're getting the lowest price, we make the greatest gains. But to do that, you must go against the majority, right? You must have no emotions that are linked to people. Very, very important, right? So that's fact number one. Now, let me move on. The other thing to understand is that when I say that the stock market always goes up, it doesn't mean that every stock will go up. Okay? So fact number two, only fundamentally great businesses will always increase in value over time. I repeat that, only fundamentally great businesses will see their stock price go up eventually. Okay? So what makes a fundamentally great business? Well, I'm going to show it to you later on, and I'm going to do a live analysis to show you how I analyze a business. Okay? Basically, a business has to pass my value momentum investment criteria. It's got to pass my 7 steps to be a great business. And in the world, less than 1% of stocks can pass my buying criteria. Less than 1%. But once you find the 1%, you know that it will always increase in value. And any short-term price drop is an opportunity to buy. So a good example is Facebook. Facebook's a great business. It's the top 1%. It will always go up because it's a fundamentally great business. So if you look at the past, every time there's bad news, right? So for example, data scandal over here. Facebook fined yet again over Cambridge Analytica scandal. Facebook shares slide down as major brands boycott Facebook. So every time there's a scandal, oh my God, scandal, boycott. What do? I buy whenever the bad news hits and the price goes down. Because it's a great business, it will eventually go higher. It's a guarantee. It will always go higher because it's a great business. Now, question people ask is, Adam, how do you know at what point to buy? I mean, if you buy there, it could go lower, right? Could it go low? How would you know? Okay, let me give you some clues. I look at the intrinsic value of the business. You see this dotted line over there? That's the intrinsic value. And I'm going to show you how I calculate that later, okay? Now, the moment the share price goes 15% below the intrinsic value, I start buying. If it goes 20% below the intrinsic value, I buy even more. When it goes 30 to 35% below the intrinsic value, I double up again. And usually by the time the price drops to 30 to 35% below the intrinsic value, that's the point where it will reverse all the way up. That's a rule of thumb. 15%, 20%, and 35% below the intrinsic value. Those are the levels where I buy more, and I buy even more. Now, I will also look at support and resistance levels as well as Fibonacci levels. So I combine both fundamentals and technicals to ascertain the level to start adding shares. And again, more on that later on. Related to this point is that fundamentally lousy businesses will not increase in value over time. So again, a business that is fundamentally lousy are businesses that are in industries that are very price competitive. They have got weak economic moats. I'll talk more about that later on. They do not have consistent growth in sales and profits. So an example is Ford. Okay, so Ford is a fundamentally lousy business. Okay, so you got to know a lousy business from a good business. You have to always understand the business behind the stock that you buy. Okay, so if you take a look at the last 20 years, what has happened? Every time it goes up, it goes lower. Goes up, goes down. Goes up, goes down. And in 20 years, Ford went from $28 to $7. Okay? So I'm here to tell you that in investing, 90% of success is understanding the business. 90% of success is fundamental analysis. Only 10% is technical analysis. The trouble with most retail investors is they do the opposite, right? They focus all on the technical analysis, all on the chart patterns. They focus on the wrong thing, and they don't understand the 90% of the fundamentals. So we'll talk more about that later on, okay? Now, fact number 3, the US stock index makes annual gains 74% of the time. Now, take a look at the last 69 years. These are the annual gains and losses of the S&P 500. So, for example, in 1951, the market went up 16%. In 1952, it went up 11%. 1953, it went down 6%. So, up and down, right? So, in 2019, last year, the market went up 28.9%. Now, this year is not over yet. We are halfway through the year, but so far, we are up about 2% for the year, okay? So in other words, in the last 69 years, 51 years ended with a gain. 18 years ended with a loss. So what's the probability of ending a year with a gain? The probability is 74%. And the probability of the market ending the year down is 26%. So here's the interesting thing, right? Every year, people ask me, Adam, do you think the stock market is going up or down this year? Guess what I say every single year? And I say the same thing every single year. Every single year at the beginning of the year, I'll say that the stock market is going up this year. I always say that. Why? Because if I say that the market is going to go up this year, I will be right 74% of the time. I'll be right most of the time. So it's not because I'm a genius, it's because statistically, if you are bullish, you'll be right 74% of the time. Think about that, right? And when people say the stock market is going to crash this year, it's going to crash this year, it's going to crash this year, statistically, they will be right. Yes, they will be right 26% of the time. Okay? So I'd rather be right 74% of the time than 26% of the time, if you think about it. Okay, next. Let's move on, guys. Fact number 4. Yes, although the stock market always goes up, but it does not go up in a straight line. It moves in cycles of bull markets and bear markets. It's kind of like the weather, okay? So the bull market is like summer. Now you can't have summer forever. After summer, you're gonna have winter. But winter doesn't last forever. Eventually, winter will end, and what follows winter? Summer will come again. So it's a cycle, right? It's always a cycle. Does it make sense? Okay. So how often do these cycles of summer and winter last? Well, let's take a look at this chart. It's a history of bull and bear markets since 1935 for the last 85 years. Now, in the last 85 years, we have had 1, 2, 3, 4, 5, 6, 7, 8. We have had 8 bull markets. The ones in blue are bull markets where the market goes up, right? How long do bull markets last? Well, this bull market lasted 13.9 years, 15 years, 6 years, 2.5 years, 12.9 years. If you add up all the bull markets, they total 78 years. How long do bear markets last? This bear market lasted 6 months, 6 months, 1.6 years, 1.8 years, 3 months. If you add up all the bear markets, they total 8 years. So statistically, and again, I'm a statistics guy, right? Statistically, out of 85 years, 78 years, we are in a bull market. Market goes up. And 8 years, we're in a bear market. So in other words, the market is in a bull market 91% of the time. Let me repeat that. The stock market is in a bull market 91% of the time. So people who bet on a stock crash, right? They bet on a stock crash. Will they be right? Yes, but they will be right only 9% of the time. And 91% of the time, they're going to be wrong. So at the end of the day, they will always lose money because they're going against the statistics. Now, if you are bullish and you're betting on the market going up, you will be right 91% of the time. What else can you ask for? Does this make sense? Now, a lot of people have been asking me, Adam, the market just crashed in February, right? The market crashed 36%. Is it going to crash again? Is it going to crash again? I can't predict the future, but what I can show you are some statistics. Now, let's look at these statistics. How often has the market declined in the past? Let's look at the last 30 years, but these statistics apply to the last 100 years as well, okay? Now, in the last 30 years, the stock market has dropped at least 5%, 39 times. Let me repeat that. The stock market has dropped at least 5%, 39 times in the last 30 years. So what does that mean? That means statistically, the stock market drops at least 5% once a year. Okay? So once a year, expect a 5% drop at least. Next, out of the 39 times, 15 of those times, the market dropped at least 10%. So in other words, once every 2 years, the market will drop 10%. Out of those 15 times, 6 of those times, the market dropped at least 20%. Now, 20% drop is called a bear market. So in other words, how often do we get a bear market or a drop of more than 20%? We get a bear market roughly once every 5 years. Okay, so those are the statistics. Now think about this. Think about this. In February and March of this year, we just had a bear market because of the pandemic. The market dropped 36% in March and February. Okay, so if you think about it statistically, this happens once every 5 years. So in other words, when do you think the next big crash is coming? That's right, 5 years from now. We've got another 5 years to party. Yeah. Statistically, right? And remember that once a year, the market's going to drop another 5%. So within the next 1 year, we're going to get a 5% drop. But another big crash, I'm sorry. You've got to wait 5 more years for that because we have already met our quota for this year in a way, all right? Now, let me quote this guy, Peter Lynch. And he said this interesting fact. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Think about that. Okay. Now, if you look at the S&P 500, this is the last 30 years. In the last 30 years, have we had crashes? Have we had bear markets? Of course. Where are the bear markets? Let's point them out, right? So we had a big crash there, dot-com crash. We had a big crash here, subprime crisis. We had another crash over there. We had another crash over there. We had this crash over here. We had this big crash over here, right? The market crashes. And people are so afraid of these crashes. But question, look at the gains. So in the last 30 years, even if you went through the crashes, even if you factored in the crashes, would you have made a lot of money? Yes, you would have. Now, the trouble is many people, after a crash like this, they are so afraid they do not dare to get in. So they say, I'm going to get in on the next crash, get in on the next crash, get in on the next crash, get in on the next crash. When it crashes, they say, it's going to get worse. I'm not going to get in. Get in on the next crash, get in on the next crash, get in on the next crash, get in on the next crash. When it crashes, oh my God, what if it gets worse? It's going to get worse. Get in on the next crash, right? And they keep waiting and waiting. And because they keep waiting for that big crash, they lose out even more money over time. All right? Does this make sense, guys? Now, of course, some people are saying, Adam, is there a way to avoid going through these crashes? Is there a way to get out there and get back in here? Get out there and get back in here. Is there a way? Yes. In fact, I've taught this many times in my YouTube videos by reading the trends of the market, getting out at the start of a downtrend, getting back in at the start of an uptrend again. And again, more on that later on. Okay. Okay, last fact. The stock market is not the economy. Even Hitler has learned this lesson, right? The stock market is not the economy. Those of you following me on YouTube will remember that back in early April, I released 2 videos. The first video was about the stock market bottom. I said the stock market has bottomed. Now, time to buy. This was back on the 3rd of April. And on the 10th of April, I had the next video that says it is confirmed that the bull market is back. When I said that the market had bottomed and the bull market has started, a lot of people lost their shit. And a lot of people said I was crazy, right? These were some of the comments that people said. You know, come on, Adam, it's pretty dangerous to be advising to buy stocks now. How many bull markets have survived a recession or depression? It's probably a bull trap, not a bull market, right? Unemployment isn't at its peak yet. Okay, bull trap, bull trap. The video will not age well. You know, dumb Adam Khoo, right? This video is aggressively irresponsible. People are going to get hurt. This is a serious recession, maybe even a depression. This guy is clueless. Can't wait to revisit this video to see how wrong this clown is. Who agrees that right now is not the time to buy stocks? So the majority of people made this mistake because they thought that the stock market was the economy. The stock market is not the economy. Remember that the stock market moves ahead of the economy by many, many months. Even Jim Cramer, he said on the 6th of April, he said, I am convinced there'll be more selling. So even professionals got it wrong, right? So remember that whenever you see bad news, right? Unemployment is at a high, job losses, pandemic, Great Depression, and this was in late March, early April. What do? Most investors would sell. Most investors would not buy. But now you know that in times of panic at the worst recession, that's when you buy. When you buy at the worst economic news, you buy at the start of the bull market. That's how the market works. If you take a look at this chart, you will understand why. Can you see that the market bottoms? Can you see the market bottom there? Now, the red line, this red line that you see, that's the stock market. The green line is the economy. Can you see that? So you can see that when the stock market is at the bottom, when the red line is at the bottom, that's when you want to buy. And you buy when the economy is in a recession. That's how you catch the bottom. The trouble is most people buy stocks when they see the economy in a full recovery. When the economy is in a full recovery, the stock market is at the top and ready to crash. So most investors buy there and they die. And they sell here. They buy there and they sell here, and that's why they keep losing money. So as intelligent investors, we need to buy during the recession and start to take profits during the full recovery. We do the opposite of the economy. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.